Here are the crypto top headlines covered in this video. Advocacy group urges SEC rethink crypto probes and lawsuits from day one. Next, a Bitcoin Reserve Act may end crypto's 4-year boom-bust cycle. Also, Deutsche Bank working on institutional crypto solution for regulatory hurdles, says report. Welcome to Crypto Top Headlines, where there are no speeches on my opinions, just bringing crypto's news to you. I would greatly appreciate it if you would click on the like and subscribe buttons as well as the notification bell. It does help support the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline, Advocacy group urges SEC rethink crypto probes and lawsuits from day one. The Digital Chamber issued a crypto agenda for the incoming SEC leadership to repair its troubled relationship with the crypto industry. A crypto advocacy group has called for the United States Securities and Exchange Commission to initiate an immediate review of all existing crypto-related investigations, Wells notices, and ongoing lawsuits from day one of the forthcoming Trump administration. The Digital Chamber's Token Alliance, which lists Trump's nominee for SEC Chair Paul Atkins as an advisory board member, said the new administration presented an opportunity for the SEC to reset its historically troubled relationship with the digital asset industry. We need to foster a culture of mutual trust where the digital asset industry can have confidence in the SEC's intentions and the SEC can recognize that most digital asset participants are striving to operate responsibly, it said in a December 18th statement. The SEC is still engaged in legal battles with industry heavyweights, including Binance, Coinbase, Consensus, and Ripple. It has also sent Wells notices to Uniswap and Immutable, which could have major implications for tokens and the industry. Ending policy of regulation by enforcement. The recommendation to review all existing investigations forms just one part of a long list of proposed priorities for the SEC during the first 90 days of the new administration. It also calls for the SEC to seek stays for ongoing litigation cases that don't involve fraud, investor loss, or risk of imminent harm, allowing time to finalize the regulator's approach. Another priority for the SEC would be to rescind the 2019 framework on how the Howey Test's investment contract argument applies to digital assets and to declare that it no longer refers to the Hinman speech to conduct such analysis. The speech by William Hinman, former SEC director in the Division of Corporate Finance, has improperly created a winner and loser dynamic, the Digital Chamber said. The Digital Chamber also wants the SEC's Staff Accounting Bulletin 121 or SOB 121 rule to be rescinded. SOB 121 requires SEC reporting entities that custody cryptocurrencies to record those holdings as liabilities on their balance sheets. The Digital Chamber said the rule was burdensome on market participants, while House Representative Wiley Nickel has said that it may push for U.S. investors offshore to riskier custodial solutions. A SOB 121 repeal bill received bipartisan support in the House and Senate before being vetoed by President Joe Biden. The new SEC may also consider whether it should withdraw from proposed Rule 3B-16, which would expand the definition of exchanges to include decentralized finance protocols, among others. SEC Chair Gary Gensler, viewed as the orchestrator behind the regulation by enforcement approach, is set to step down on January 20th and is tipped to be replaced by Atkins, who previously served as an SEC commissioner from 2002 to 2008. The Digital Chamber's proposal may hold some weight as Atkins serves on its advisory board and Token Alliance Leadership Committee members met with SEC Commissioners Hester Peirce and Mark Ueda to present the policy priorities. Let me pause here for a moment. If you're getting value out of this video, please click on the like and subscribe buttons as well as the notification bell. Our next top headline, a Bitcoin Reserve Act may end crypto's 4-year boom-bust cycle. The Bitcoin Reserve Act could break the halving cycle. Is this 4-year cycle going to play out differently? Will we enter the mythical super cycle? With speculation mounting that incoming President Donald Trump may sign an executive order declaring a Bitcoin reserve on day one, or pass legislation to establish a reserve during his term, many wonder if the move could lead to a crypto supercycle. Since Wyoming Senator Cynthia Lummis introduced the Bitcoin Reserve Act earlier this year, states like Texas and Pennsylvania have filed similar proposals. Russia, Thailand, and Germany are reportedly considering proposals of their own, further ramping up pressure. If governments are competing to secure their own stockpiles of Bitcoin, we would say goodbye to the 4-year boom-bust cycle in crypto prices that many attribute to Bitcoin's halving. Ilya Kalchev, dispatch analyst from crypto lender Nexo, believes the Bitcoin Reserve Act could be a landmark moment for Bitcoin, signaling its recognition as a legitimate global financial instrument. Every Bitcoin cycle has a narrative trying to push the idea that this one is different. The conditions have never been so ideal. Crypto has never had a pro-crypto U.S. president who controls the Senate and the Congress. Lummis's proposed Bitcoin Act 2024 would enable the U.S. government to insert Bitcoin into its treasury as a reserve asset by buying 200,000 BTC annually over 5 years, accumulating 1 million Bitcoin, which it would hold it for at least 20 years. Jack Mallers, founder and CEO of Strike, believes Trump has the potential to use a day one executive order to purchase Bitcoin, although he cautioned that it would not equate to a 1 million Bitcoin purchase. Dennis Porter, co-founder of nonprofit organization Satoshi Act Fund, which supports pro-Bitcoin U.S. policy bills, also believes Trump is exploring enabling a strategic Bitcoin reserve through an executive order. So far, Trump's team has not directly confirmed the claims about an executive order, but Trump was asked on CNBC if the U.S. would create a BTC reserve similar to its oil reserve, which could mean legislation, and he answered, "Yes, I think so." An executive order, however, would lack stability, as subsequent presidents often reverse such orders. The only way to ensure the long-term future of a strategic Bitcoin reserve would be with legislation with majority support. Bitcoin advocates on Trump's team have solid ground to push Lummis's bill as Republicans dominate Congress and have a slim majority in the Senate. However, just a few Republican defectors, swayed by progressive outrage over supposedly handling the government's wealth to Bitcoiners, could derail the bill. Stop comparing this cycle to prior cycles. Earlier this month, Alex Kruger, economist and founder of macro digital assets advisory firm Asgard Markets, said the election result made him believe that Bitcoin is highly likely in a super cycle. He believes that Bitcoin's unique situation could be compared to gold when it surged from $35 per ounce in 1971 to $850 in 1981 as former U.S. President Richard Nixon ended the gold standard in Bretton Woods. Kruger did not rule out the possibility of Bitcoin going through a bear market as in past cycles. However, he urged the crypto investors to stop comparing this cycle to prior cycles, as it may be different this time. Trump's actions to date certainly suggest a favorable administration going ahead. He's nominated pro-crypto and pro-deregulation Paul Atkins as a nominee for the Securities and Exchange Commission chair after Gary Gensler stepped down. He's also nominated pro-crypto Scott Bessent as Treasury Secretary and designated former PayPal Chief Operating Officer David Sachs as AI and Crypto Czar, tasked with developing a clear legal framework for the crypto industry. Supercycle theory has never had super results. However, the concept of this cycle being different has surfaced in every past Bitcoin bull market, each time backed by narratives surrounding mainstream and institutional adoption. During the 2013 to 2014 bull run, the supercycle theory was supported by the theory that Bitcoin would gain international interest as an alternative asset to fiat currencies. In the 2017 to 2018 cycle, the rapid price appreciation was thought to be a sign of mainstream financial adoption and the beginning of Bitcoin's mainstream acceptance, where institutional interest would thrive. In the 2020 to 2021 cycle, When tech companies such as MicroStrategy, Square, and Tesla entered the Bitcoin market, they believed many tech-related companies would follow suit. However, in each cycle, the supercycle narrative was not fulfilled, ending in a price crash that wiped out proponents as it entered a prolonged bear market. Su Zhu, co-founder of Three Arrows Capital, was the most notable proponent of the supercycle thesis from 2021 and argued that crypto markets would remain in a bull market without a sustained bear market, with Bitcoin eventually peaking at $5 million. 3AC certainly borrowed money as if the supercycle thesis was real, and when it was eventually liquidated, the crypto market cap fell by almost 50% on the news, and the collapse led to bankruptcies and financial difficulties for lenders including Voyager Digital, Genesis Trading, and BlockFi. So a supercycle is a dangerous theory to bet your life savings on. For Chris Brunswik, partner at venture capital firm Placeholder and former blockchain products lead at ARK Invest, the Bitcoin supercycle is a myth. Supercycle is without fail a collective delusion. Nevertheless, the U.S. election results have overwhelmingly provided Bitcoin with unprecedented and extremely bullish conditions, considering the backing of a U.S. president who seems to be following through with his pro-crypto promises, among them to never sell Bitcoin from the U.S. Bitcoin stockpile. The potential global domino effect. If the Bitcoin Reserve Act is passed, it may kick off a global hodling race as other countries follow suit to avoid being left behind. George S. Georgiades, a lawyer who transitioned from advising Wall Street firms on capital raising to working with the crypto industry in 2016, told Cointelegraph that enacting the Bitcoin Reserve Act would mark a turning point for global Bitcoin adoption and likely trigger other countries and private institutions to follow suit, driving broader adoption and enhancing market liquidity. Basil Ismail, CEO of crypto investment analytics platform BlockCircle, agreed and said approval would be one of the most bullish events in crypto history, as it'll catalyze a race to acquire as much Bitcoin as possible. Those other nations won't have a voice, their hand will be forced, pivot and compete or die. He believes most of the G20 nations, which are the most powerful and most economically advanced countries in the world, would follow suit and create their own reserve stash. Veteran crypto investor and Bitcoin educator Chris Dunn said to Cointelegraph that such a FOMO-based competitive buying spree among countries could completely alter the current crypto market cycle. If the U.S. or another major economic power started accumulating, Bitcoin could trigger a FOMO, which could create a market cycle and supply-demand dynamics unlike anything we've seen so far. Hong Fang, OKX exchange president, told Cointelegraph other countries may already be positioning themselves for such a race. Game theory is likely already quietly in play. However, Ismail said much of the Bitcoin purchases will be done via over-the-counter brokers and settled as block trades, so it may not have an immediate direct impact on the price of BTC, but will instead create a long-lasting demand force which will eventually push upward the price of Bitcoin. The new wave of crypto investors may alter crypto market dynamics. The Bitcoin market would likely change radically if states become market buyers. A new wave of new investors from global financial centers would flood the crypto markets, changing the market dynamics, psychology, and reactions to certain events. While it remains speculative to assume this legislation could disrupt Bitcoin's well-known 4-year halving cycles, several dynamics might evolve, said Nexo analyst Kalchev. Bitcoin is a unique market, driven so far by retail buying and selling with the price highly reactive to market psychology. The emergence of new types of investors could shift market dynamics, altering historical cycles. Ismail believes that investors from the equities market will behave differently than hyper-reactive retail investors. Institutional players bring deep pockets and advanced risk management strategies, which allow them to approach Bitcoin differently than retail investors. Over time, Wall Street's participation could contribute to a more stable, less reactive market environment. Stabilization is another way of saying less volatile, which would logically mean bear markets would be less aggressive than in past cycles. Georgia Des believes that price cycles will persist, but sustained demand from large-scale buyers like the U.S. could reduce volatility and the swings we've witnessed over past cycles. Ismail, meanwhile, pointed out the Bitcoin market is already behaving differently to previous 4-year cycles. Bitcoin's price in the current cycle fell below the last cycle's all-time high, which everyone believed was impossible, and then Bitcoin reached a new all-time high before the formal halving took place. The 4-year cycle has already been debunked and broken multiple times now. Bitcoin has only seen 4 halvings so far, with nearly 30 halving events yet to occur. It's difficult to imagine that all these halvings will follow the same predictable 4-year pattern, said Kalchev, especially as broader macroeconomic and political factors, such as central bank policies and regulatory developments, exert more significant influence on Bitcoin's market trajectory. Kalchev believes Bitcoin's price movements will become less tied to internal mechanics like the halving and more influenced by external factors such as institutional adoption and geopolitical events. Our next top headline: Deutsche Bank working with institutional crypto solution for regulatory hurdles, says report. Germany-headquartered Deutsche Bank is reportedly developing a solution for the regulatory challenges that financial institutions face when using public blockchains. Bloomberg reports that the global investment bank is building a Layer 2 blockchain for leading smart contract platform Ethereum to address regulatory concerns of financial firms such as inadvertently dealing with criminals and sanctioned entities. The Layer 2 chain is incorporated in the firm's multi-chain asset servicing pilot, Project Dama 2, which is part of the Monetary Authority of Singapore's, or MAS, Project Guardian initiative, a collaboration of 24 major financial institutions that explore asset tokenization. Deutsche Bank's Asia-Pacific Industry Applied Innovation Lead Boon Hyung Chang says public blockchains such as Ethereum come with risks for regulated lenders such as not knowing who validates transactions, concerns over payment of transaction fees to sanctioned entities, and threats of unforeseen hard fork. Chang says the Layer 2 solution can help address these issues. He says the platform will allow banks to curate a more bespoke list of validators and potentially grant regulators super admin rights that will enable them to scrutinize fund movements. Using 2 chains, a number of these regulatory concerns should be able to be satisfied. You are not dependent on the Layer 1 for detailed transaction records anymore. The bank launched a test version of Dama 2 in November and is hoping to launch a minimum viable product by next year. So this concludes Crypto Top Headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.